Okay, let's dive right into this absolutely staggering number, $92.28 billion. dollars. That is the massive market capitalization of the heavyweight contender we are putting through the ultimate investment gauntlet today. When you see a number that large in the energy infrastructure space, you just know you are looking at a foundational piece of the economy. But as we all know, size alone doesn't guarantee a great investment, and that's exactly what we're here to figure out. Welcome to This Explainer. Today, we are putting on our expert investment analyst hats to run the Williams companies through a truly rigorous fundamental test. We aren't just going to look at surface level numbers here. We're going to apply the legendary valuation frameworks of three investing titans: Warren Buffett, Peter Lynch, and Benjamin Graham. Then, we'll bridge the gap between classic value investing and modern finance by crunching some strict quantitative models. By the end of this, you're going to know exactly what this company is truly worth. Here is our agenda for today's analysis. First, the company snapshot. Second, the Buffett lens. Third, the Lynch lens. Fourth, the Graham lens. Fifth, DCF and quantitative valuation. And finally, number 6, our synthesis and final verdict. All right, starting with section 1, WMB, the company snapshot. Let's get our baseline. The Williams Companies, trading on the New York Stock Exchange under the ticker WMB, is a total giant in the midstream pipeline space, specifically focused on natural gas. And when I say giant, I mean they literally handle 1/3 of the nation's natural gas. Think about that for a second. They operate the physical infrastructure, the pipelines, the gathering facilities, the processing plants that actually connect supply basins with major demand centers like power generators and utilities. They are essentially the toll takers of the American energy highway. Now, looking at their current numbers, WIM-AB is trading around $75.01. Right off the bat, that price to earnings, or PE ratio, jumps out at us. At 33.1x, that is somewhat high for a utility-style business. However, you've got to balance that against an incredible 52 consecutive years of dividend payments. They're targeting a freshly hiked $2.10 annualized payout for 2026. Plus, the top line is extremely robust, pulling in nearly $12 billion in projected revenues for 2025. Let's move to section 2 and run this through our first test, the Warren Buffett lens. You know, Buffett, it is all about the economic moat. He wants to know, can competitors easily steal your business? Well, with the massive infrastructure required to supply 1/3 of U.S. gas, Williams has an incredibly deep physical and regulatory moat. You simply can't just wake up tomorrow, scrape together a few $1 billion, and start laying a new pipeline network across the United States. The regulatory hurdles and massive capital requirements mean Williams' existing assets are immensely protected. So how does WNB hold up to Buffett's strict standards? Pretty darn well, actually. They generate a very strong 19.7% return on equity. And despite the heavy capital needs of pipelines, they maintain a totally manageable Fitch BBB investment grade rating with a low 3.61x leverage ratio. But most importantly, Buffett looks for owner earnings, the actual cash the owner can take out of the business. We model this using their 2025 available funds from operations, which sits at a massive $5.85 billion. Buffett would absolutely love the business quality here, though he might just wait for a slight dip in price to ensure he gets his preferred margin of safety. Next up, section 3, the Peter Lynch lens. Let's see how a growth-focused mind looks at this. Peter Lynch was all about finding growth at a reasonable price, and for that, he leaned heavily on the PEG ratio. A standard PE ratio doesn't actually tell you much if a company is growing rapidly. By factoring in earnings per share expansion, the PEG ratio tells you if you're overpaying for that growth. Generally speaking, a PEG of 1.0 is considered fair value in Lynch's playbook. Lynch famously categorized companies into different buckets. We'd put WMVs somewhere between a stalwart and a slow grower because of its utility-like nature. Usually, these large pipeline companies are just slow, steady dividend payers. But interestingly, recent data shows WMB achieved a 25.2% jump in EPS growth. That shows it still has some serious operational momentum, which is typical of a stalwart that can really protect your portfolio during a recession. But here is where it gets a bit tricky for a Lynch investor. The PEG ratio sits at 1.3x. That means it isn't a screaming bargain, but it's not wildly overvalued either. However, Lynch loved clean balance sheets, and WMB has a current ratio of 0.8x and a massive 199.9x debt-to-equity ratio. Now, while heavy debt is standard practice in the pipeline industry, it completely violates Lynch's strict balance sheet rules. Because of that, this falls into a Lynch-style hold rather than an aggressive body.
All right, time for the toughest test in our gauntlet. Section 4, the Benjamin Graham lens.
Benjamin Graham is the ultimate deep value skeptic. He evaluates a stock's tangible worth using his famous intrinsic value formula, which is the square root of 22.5 multiplied by the earnings per share and the book value per share. Graham didn't care at all about narratives or future projections. He only cared about hard, tangible assets that he could buy for pennies on the dollar.
When we run WMB through Graham's strict defensive investor checklist, it's a bit of a mixed bag. The company easily sails through his requirements for adequate size, financial stability, strong earnings, and that legendary 52-year dividend record, but it hits an absolute brick wall on valuation. It completely fails his test for moderate multiples. A 33.1x PE is just way too rich for a traditional hard-nosed value investor.
Let's actually calculate Graham's exact intrinsic value for WMB. We take the projected 2025 EPS of $2.14 and calculate the book value by dividing their $14.99 billion in equity by 1.22 billion outstanding shares. That gives us a book value per share of $12.24. Plugging those numbers into his formula yields a brutally strict intrinsic value of just $24.27. With the stock trading around $75, it's at a roughly 200% premium to Graham's value. The margin of safety is completely non-existent here. For Graham, this is a clear, undeniable sell. Let's leave the classic qualitative gurus behind for a minute. Section 5, DCF and quantitative valuation. Building a discounted cash flow, or DCF model, requires some forward-looking assumptions you won't just find printed in a 10K. So here are our parameters. We start with their massive 2025 operating cash flow of $5.89 billion and back out $4.29 billion in capital expenditures. Then we estimate a 7.5% weighted average cost of capital, which is the standard required rate of return for the midstream industry, along with a conservative 2% perpetual terminal growth rate for a 5-year forecast period. When we project those free cash flows forward and discount them back to the present day using our cost of capital, our base case DCF valuation spits out an estimated fair value of roughly $82 per share. This suggests that the future cash the company is going to generate actually justifies a price tag slightly higher than where it's trading today. But as any expert analyst knows, you never just trust a single number. You have to look at the sensitivity table. If WMB's cost of capital rises just slightly to 8%, maybe due to rising interest rates, the intrinsic value drops to $76. Notice how that puts it right in line with the current $75 trading price? The math is telling us this stock is fairly valued right now, with a slight bias toward the upside. To cross-reference our own DCF, let's look at some other quantitative models. Factoring in dividend discount models and the consensus from 8 top Wall Street analysts, we see a median price target of $84. This aligns beautifully with our $82 DCF calculation, implying about a 12% upside. The most bullish analysts have a high-end target stretching all the way to $98, largely factoring in rapid growth in their power innovation and natural gas volume expansions. All right, let's bring it all together. Section 6, synthesis and final verdict. Blending these frameworks gives us some incredible clarity. The deep value skepticism of Benjamin Graham screens this as a hard sell. Buffett and Lynch respect the massive moat and the growth, but they both see the current price as a hold. However, modern dividend growth DCF models and analyst consensus point to a modest buy around the $82 to $84 mark. Ultimately, WMB screens as a solid hold at its current $75 price point. It serves brilliantly as an inflation-protected income asset yielding a growing dividend rather than a severely discounted bargain stock. So I'll leave you with this final thought. Based on the rigorous gauntlet we just ran, is Williams' undeniable infrastructure moat a fortress for long-term dividend seekers? Or is its 33x PE ratio a value trap for deep value bargain hunters? Consider your own investment strategy, weigh those incredibly stable cash flows against the high multiples, and decide for yourself. Thanks so much for joining me on this explainer, and keep analyzing those fundamentals.